Money is an integral part of our daily lives, but its journey to what we know today was long and complex. Over thousands of years, humans have developed and refined systems of exchange to facilitate trade, build economies, and create wealth. The story of money is one of innovation, adaptation, and change. Let's take a look at how money evolved from simple exchanges of goods to the digital currency systems we use today. Before money existed, people exchanged goods and services directly in a system known as barter. Early humans traded items like food, tools, or livestock to satisfy each other's needs. For example, a farmer might trade a basket of grain in exchange for a goat, while a blacksmith could offer his services in return for wheat. However, bartering had inherent problems. It required both parties to have something the other wanted. If the farmer needed a goat, but the herder had no interest in grain, no trade would happen. This double coincidence of wants made bartering an inefficient system for larger, more complex societies. As societies grew, people began to use commodity money, goods that held intrinsic value, such as livestock, grain, or precious metals. These commodities served as a more practical form of trade, since they had value in and of themselves. One of the earliest examples of commodity money was cattle. Livestock were highly valuable and could be used as currency for trade in many ancient cultures. Similarly, grains like barley and wheat were used as money in ancient Mesopotamia, as they were essential for survival and were easy to trade. Eventually, metal objects began to be used as money. Early civilizations, including those in Mesopotamia and Egypt, began using precious metals such as copper, gold, and silver, which were durable, scarce, and easily recognizable. These metals were often shaped into bars or used to create jewelry, both of which had value in trade. The real breakthrough in the history of money came around 600 BCE, when the Lydians of Anatolia, modern-day Turkey, created the first metal coins. These coins were made of electrum, a naturally occurring alloy of gold and silver, and they were stamped with images to guarantee their value and authenticity. The introduction of coinage solved many of the problems that the barter system posed. Coins were easy to carry, standardized, and had intrinsic value due to the precious metals they were made of. They also facilitated trade beyond local markets and allowed for international commerce to flourish. Coinage quickly spread across the ancient world, from the Greeks and Romans to the Persians and Egyptians. Each civilization began minting their own coins, and the use of money became more widespread and standardized. Coins marked the beginning of an era in which currency could be used for larger, more sophisticated economies. While coins remained a dominant form of currency for centuries, the need for lighter and more convenient forms of money led to the development of paper money in China. The Chinese Tang dynasty was the first to use paper as a form of currency, but it was during the Song dynasty that paper money became more common. Initially, paper money in China was issued as promissory notes by merchants, guaranteeing that the bearer could redeem the note for goods or precious metals. The government eventually took over the printing and issuance of paper currency, making it official and accepted across the empire. Paper money was a huge innovation because it was much lighter and easier to carry than metal coins, making it ideal for long-distance trade and large transactions. As economies grew more complex, the need for sophisticated financial systems increased. In medieval Europe, banks began to form, and they began issuing banknotes, promissory notes that could be exchanged for precious metals like gold and silver. These notes were essentially IOUs, and they were backed by the gold or silver deposits held by the bank. The Bank of England, established in 1694, became one of the first major financial institutions to issue official paper currency. Other European countries followed suit, and paper money gradually became more widespread. However, even with paper notes, many currencies were still tied to a physical commodity, a system known as the gold standard. During the 19th century, many countries adopted the gold standard, which meant their currencies were directly tied to a specific amount of gold. This helped stabilize economies and facilitated international trade, as countries' currencies were tied to a universally accepted commodity. However, during the 20th century, the gold standard became increasingly difficult to maintain, especially during times of war and economic upheaval. In 1971, the United States officially abandoned the gold standard, and most countries followed suit, moving to fiat money systems instead. Fiat money is currency that has no intrinsic value but is accepted as legal tender because the government declares it to be so. Today, the majority of the world's currencies, including the US dollar, are fiat currencies. In recent years, the rise of digital money and cryptocurrencies has changed how we think about and use money. Digital payment systems such as credit cards, PayPal, and mobile payment apps allow people to make payments electronically, without the need for physical cash or even traditional bank accounts. The most groundbreaking development in recent years has been the creation of cryptocurrencies like Bitcoin, Ethereum, and others. These are digital currencies that are decentralized and not controlled by any government or central authority. Cryptocurrencies are based on blockchain technology, which ensures secure and transparent transactions. While cryptocurrencies remain a relatively small part of the global economy, they represent a significant shift in how money could evolve. This is the history of money from 3000 BCE to today. Imagine what if money disappeared in the 21st century. I will tell you in another video how money controls all things and how we can live without money. Is it possible or not?